Well, some pretty heavy topics as we have rolled through earnings season on what companies are doing to navigate the macro story. One of the helpful indicators for investors is always what the margins look like on businesses. That's something Brad Conger is tracking closely. He's Chief Investment Officer at Hirtle Callaghan, and he joins us now to talk a little bit more about how to position one's portfolio. Great to have you back with us.
Thanks, John.
And this subject of margins, just one of the metrics we would look at as an investor for trying to assess the health of a business. Why would it be particularly important right now, in your opinion?
Well, the estimates for next year have the U.S. market earnings growing at about 12%. And that implies that margins are going up from 12.9 to almost 14.5 by the end of next year, 26. I think given the backdrop for tariffs, which is creating disruption in terms of supply chains and pricing power and decision making, it's going to make it very hard for U.S. companies to hit those margin targets. Now, what we've seen so far in this earnings season has been stellar. So clearly, companies have managed the very difficult, uncertain situation well, but I think it's just getting harder for the remainder of the year.
So how ultimately would you go about sort of picking stocks for one's portfolio based on kind of that overall conclusion on margins?
So we look at valuations to start with. The U.S. is 22.5 times forward earnings. That's in the upper 5 percentile of observations over the past 20 years. So the market's expensive, but it's discounting great growth opportunities. So what we are trying to do is find sectors of the market where expectations have come down, but the long-term sustainability of the margins is still intact. So I'll give you an example. Healthcare has been under a lot of pressure because of potential tariffs on the pharmaceuticals and pharmaceutical intermediates, but they're now trading at 12, 13 times. And they're fantastic companies with long-term good pipelines, good product lineup. So Novartis, Roche, Novo Nordisk are all trading 12, 13 times. And we think that's cheap relative to the secular growth.
You know, just to sort of put it into the context of lots of noise and headlines, I'm gonna zero in on Novo just as an example. You know, I think everybody knows that the weight loss drug demand is real. But we've seen, you know, all these different headlines about competition and a lot of noise around Novo. So, so you can see the stock's been under pressure. So as a long-term investor, what do you see beyond the valuation story?
So the addressable market is not just obesity, but it has indications that are cardiovascular, kidney function, liver function. And so I think the addressable market is very big for these drugs. Novo and Lilly to a lesser extent, but certainly Novo underestimated the uptake. And as a result, they faced competition from generic, or not generic, but compounders, and they really lost market share. On the other hand, they've addressed the problem. They've opened up new outlets, direct to consumer. And so I expect that over the fullness of time, they will participate in the growth of this market. And at 12 times next year's earnings or less, I don't think there is a lot of downside for a category that we think is going to grow between 10 and 15% for the next 5 or 10 years. So I think if you can just ignore the intense noise and think about what the long-term potential is, you're better served as an investor.
Okay, now I do just want to clarify for our audience, because your firm has talked about defensive growth as a theme in the past too. So this wouldn't necessarily be, you know, the highest flying growth names. It's just big companies with a lot of growth and actually a lot of profit power too. That would include the likes of Visa and MasterCard. But how do you feel about those kind of stocks now, given what you were saying about your margin concerns?
So we like the payments processors. We like the laboratory equipment producer, analytic device producers like Mettler Toledo and Danaher and Thermo Fisher. And again, these are companies that have gone through some pressure as the COVID sort of boom has unwound. But the long-term sustainability of the demand for those products, and we're talking payments and lab services and GLP-1, it's not AI driven. I think, and I think the AI euphoria has run too far in terms of the prices of those stocks. So we're seeking growth that is more what we think is more sustainable.
All right, Brad, great to get your perspective as always. Thanks very much for the time today. Brad Conger joining us, Chief Investment Officer at Hirtle Callaghan.